everyone. I hope this email finds you well and enjoying the last few days of summer and the beautiful weather before the lovely rain begins on the West Coast. Um, I wanted to give you an update just a couple days after the prime rate was decreased by a quarter point by the Bank of Canada. And I'll add to this is it was anticipated that there was considerations that a half point drop was being considered. So we did receive a quarter point, and that is the third consecutive rate cut of a quarter point within the past few months or so. And we are anticipating more. So to bring you up to speed with a brief update is I'm just going to, like I typically do, I'm going to run through some figures. And we are seeing basically from the Bank of Canada is we are seeing that there's downward pressure on supply and the economy remains resilient, but it is seeing some weakness in there. So what that means is that if inflation continues to ease in line with what our July forecast is or what the July forecast is, it is reasonable to expect further cuts. So when we say further cuts, the next one could be a half point, it could be a quarter, but the forecast is for it to decrease 1.5 to 2% by the end of next year, depending on inflation, etc. So let's have a look at inflation. Okay, so we are actually doing quite well with this. So these rates are really beginning to kick in. You can see the steady trend going down here, and this will decrease as the rates come down. This will decrease as well, just due to interest costs. A large part of inflation is the higher interest costs that everyone is paying right now. So as that subsides and the rates begin to fall, you will see inflation naturally come down as well. When I look at this, is what is the anticipation, the expectation of what's going to happen with the prime rate? So you can see here, this is the overnight rate, and we're anticipating it has dropped now down to the lower levels of 4.25. What is happening? What can we expect by the end of next year and following? Is another 1.5% in that range. And they're saying at minimum, some economists are saying even up to 2%. So this is the forecast on the Bank of Canada website, and that just for reference. Now, what's happening with bond yields? Now, the trend right now between, if you're going to take a mortgage right now, it's typically going to be either a 3-year fixed or a 5-year variable. Now, I'm suggesting or recommending to many of the people I work with right now is to consider the variable. And the reason being is that you can see here is these are the bond yields, okay, 3-year bond yields. So the price of a 3-year fixed up here would have been maybe, let's just say 5.45 or something like that. Once we get down here, now it's pricing in 4.7, 4.8. So you can see here back in the first rate cut in June, the bond yields fell. Then here we've got inflation popped up a little bit, so the bond yields went up, and then we had unemployment popped up. Okay, so those bond yields begin to fall. Then we get the July meeting and the July cut, and all of a sudden we see this decrease more. So every time the Bank of Canada cuts their rates, you will see a fluctuation or like a decrease in the bond yields. And you can see already is that we have this rate cut, the most recent one on Wednesday, and these bond yields have already fallen. Looking at the unemployment rate. Now, this came out recently as well, as you can see the steady trend of the unemployment going up. So as I keep saying is everything that all these rate hikes and that are really settling into the economy now. Have they gone too far? We'll see what happens as time progresses, but it's something to keep an eye on, and I'll keep you posted on that. The last thing I want to cover is if someone was going to take a 3-year fixed or a variable today, I'm just going to do a quick little consideration here, just a comparison, is today, and this could change tomorrow, is you can get a 3-year fixed for about that 4.79. And that if we amortize it over 25 years, we have a $500,000 mortgage. The payments are about $28.48. If we look at a variable, and after that prime rate is dropped down to 6.45, we can get a variable rate mortgage for about prime less 0.8. You can see here the payments are a touch higher, but over the next 3 years, we're comparing this side by side, is you'd lose about $12,500 just based on the rate. If we go a little bit deeper and we look in the forecast of what is anticipated over the next up till January 2026, if we factor that in, then we're actually saving some money. And what I'm advising or just letting clients know is that because of this, I don't think there's anything wrong. The variable rate mortgages are making a comeback. And even if you want to lock in at a later date, at least ride the prime rate down. Even though you start a little bit higher, it's something to consider, and you've got more flexibility. So I hope this was helpful. If you have any questions, please reach out. And if you need anything, or your mortgage coming for renewal, or any advice or tips whatsoever, please reach out and we're happy to help. Keep well and have a great fall. Bye for now.